Okay, welcome guys. So today we're going to be talking about Fibonacci retracements. Um, so this is quite an important topic, and the reason is what we are looking for mostly as traders is that we're always looking for best ways to enter the market, best entries with the lowest risk and the highest, potential reward, right? That's what we're always looking for. That's the reason we learn how to analyze the market. That's the reason why we try to understand the market in depth. That's the reason why we learn different trading strategies. The goal is for us to be able to fine-tune entries, be able to get on the best possible entries so that we can reduce our potential risk, and also be able to maximize our rewards, right? So we want to be able to achieve good quality risk to reward ratios. That's why we're mostly looking for strategies. And so Fibonacci is one of those strategies that, works well with the entirety of how the market works, right? It tends to operate with the way the market works, because the market works most of the time with impulse pullback continuation, impulse retracement continuation, right? So Fibonacci is one tool that comes with the platform, that comes with our MT5 platform, or if you're trading on TradingView, it comes with the platform and is a very effective tool to helping you discover where you should be entering the markets, right? So that's the reason why we talk about it. In most of the analysis we do, you see we tend to use it a whole lot of times. And the reason for that is because it has a high level of accuracy when it comes to helping you analyze the market and looking for areas where you want to enter the market for a buy or for a sell, right? So that's what we'll be talking about, how it works and how to use it during the course of this video. All right. I'll be showing us this from the MetaTrader platform on the computer, right? So that's what we'll get started. We'll show how it is done, how we use it. If you're going on a buy trade and you're going on a sell trade, how do you position this tool properly so that it can capture for you the best possible entries for a buy or for a sell? All right. So let's get started. So when we're looking for Fibonacci, this is the tool here. Fibonacci retracement. This is a tool here, right? And then once you click on this, click on that, it helps you pick your Fibonacci retracement from top to bottom. Okay. Now, if you see what I have drawn here, this Fibonacci retracement is actually already fine-tuned, which means I already fine-tuned it. So what I'll do is I'll try to take it back to default and then see how we can, I'll try to take it back to default and then see how I can redo it for you to be able to get it. Or what I would rather do is I would edit it and show you how to get to these settings, right? Because by default, when you open it for the first time, it doesn't give you the Fibonacci levels like this. Even though these Fibonacci levels are there, but it doesn't give you these Fibonacci levels like this. And also I added an extra Fibonacci line here that usually don't find on your Fibonacci lines, especially on MetaTrader. That extra layer is 78.6 and is available on TradingView. If you're trading on TradingView, you definitely see it there. But if you're trading on MetaTrader, it won't be there. So I added it here. So let's start by setting it up and all that. So when you come to your chart, the first thing you do, you click on the Fibonacci retracement here. This is the tool again. It's on the third line and it's just where you find your time frames and all your basically all your marking tools. The tools you use for marking up your charts, your trend lines, horizontal lines, crosshairs, all of that is also where you find your Fibonacci retracements. Okay, so we'll pick the Fibonacci retracement, and then first of all, the way you use Fibonacci retracement is it depends on where you are looking at the market going to. So it starts by understanding trends. Okay, now I've said this several times that when you want to trade, the first thing you want to try to do is understand trends, understand the trend of the market. Where is the market going? Where is the market, what direction is the market going, right? Is the market in an uptrend? Is the market in a downtrend? Is the market in a consolidation? That's what you want to understand first. Because a Fibonacci will help you get proper entries in the direction of the trend. Fibonacci will help you get proper entries, find entries in the direction of the trend. So which means you have to, first of all, start by understanding the trend. Where's the market going first, right? So if you don't do that, you might use the Fibonacci wrongly. And then even though it gives you an area where you should be getting in the trade, you find out that that area doesn't tend to hold price. Price tends to break through that area, because what's very important is that the direction of the market is wrong, or you're not getting the direction of the market right. Now, when you look at this is AUD USD right now. The first thing you want to do is, what is the trend of this instrument currently? We're on the 1 hour chart right now. What is the trend of this instrument currently? So we can see that the market was making higher highs here and making lower highs here and lower lows, and then lower highs. Okay, so you can see, let's just start off first of all here by using this trend line here. So we can use this trend line here, and this trend line tells us that the market has been trending down for some time. Okay, now not for a very long time, but the market has been trending down for some time, maybe a couple of days or so, or maybe about a week, thereabout, or more than a week, basically more than a week. The market has been trending downwards. Now, when you look at this, you realize as the market pulled into this level, it came down again, and then at a point, you can see that there's a breakout here. Let me show us this. Okay, so let me show us this. We can see that there's a breakout here. So you can see, so the market broke through that trend line. Usually when market breaks through, when markets break through trend lines, it often indicates a change in trend. So that's what you are looking for first of all. You want to understand, where is the market going? What is the trend of the market? Now, you see market has been coming down. Then after a while, it breaks through that trend line, and it seems like even though it's still not forming higher highs yet, but the break of that trend line indicates something. Okay, it indicates something. There might be a change in trend coming. And if there's a change in trend coming, what you want to be doing when you're using the Fibonacci is to look at the market, where the market is going, and you are looking to get on trades in that direction. Okay, especially when you're looking to do this on a 1 hour, 4 hour time frame. Of course, if you're doing it on a 15-minute, 5-minute time frame, you can catch the market up and down consistently, continuously like that. But then we also know that most of the time you'll be scalping. You're scalping. But if you're looking to really catch moves in the market, you want to be able to use use your tools, look at market trends from a much higher time frame than the 15 minutes or 5 minutes, where you're basically just scalping. Okay, so that's the first thing you're looking for, the trend of the market. What is the trend of this particular instrument that I'm observing? What's the trend? That's the first thing. Then the next thing you want to do is this. For you to use the Fibonacci retracement, you will usually, first of all, identify swing highs and swing lows, mostly the most recent swing highs and most recent swing lows. That's what you're working with most of the time. Now, this will change depending on the time frame you're on. It will change depending on the time frame you're on. If you're on a larger time frame, let's say you're on the 4 hour time frame, your most recent swing high or swing low may appear different your recent swing highs and swing lows on a 1 hour or a 15-minute chart. So it depends on what you're looking for. And when it comes to chart time frame, guys, this is something that you have to determine what is best. Now, we usually would tell you that the best thing for you is to use a higher time frame, 4 hour, 1 hour, 4 hour time frame, to be able to see a clear trend. When you see a clear trend there, then if you prefer to trade on lower time frames like 5 minutes and 15 minutes for entries, that is good for you. That is good, basically, right? But then you need to be able to use a higher time frame to see clearly what the direction of the trend might actually be in the market. Okay, so the first thing, you identify your trend, right? Now, the next thing is you are identifying swing highs and swing lows. So these are the swing highs and swing lows here now. These are swing highs and swing lows. So you have a swing high here. Basically, everywhere the market got to and changed direction, that is a swing high, or that's a swing. All right. Now, when it's at the top, it's a swing high. This is a swing high. This is a swing low. So this is swing low again. This is a swing high. Yeah. This is a swing low. This is a swing high here. All of this area here is a swing high. Then we're looking at a swing low again. This is a swing low here. This is a swing high here. This is a swing low here, right? So this is what you're looking for. Identify the swing highs and swing lows. Once you've identified the swing highs and swing lows, the most recent one is what you are going to be working with. The most recent swing highs and swing lows. And then that's how you will know where the Fibonacci will be useful in. So once you have identified your swing highs and swing lows, and like I said, you're working with these most recent ones, the next thing you want to realize is this. Fibonacci retracement. First of all, let's do the editing of the Fibonacci retracement itself. So when you click on the Fibonacci retracement tool, you drag like this. You click on the chart and then you drag. You either drag from top to bottom or from bottom to top. So you either drag from top to bottom or from bottom to top. So if you're looking to enter a sell trade, you drag from top to bottom. You drag from top to bottom. And when you're dragging from a swing high to a swing low. You're dragging from a recent swing high to a swing low. That's when you are trying to enter for a sell trade. When you're trying to enter for a sell trade, you take your Fibonacci retracement tool, you drag from a swing high, recent swing high, to the most recent swing low. That will give you an area of retracement, a fair value gap, basically, in market. So when you see that, that will become an area where you are looking to get on your trade. And in this case, you're looking for a sell trade, right? So when you are looking for a sell trade, you will usually use your Fibonacci from top to bottom, swing high to swing low, most recent high, most recent swing high to most recent swing low, and that will give you an area of retracement. And your goal there is to be able to get on sell trades, right? Sell trades. And once you catch that trade, your first take profit on that trade will most likely be the next swing low, the swing low you are using for your Fibonacci. That will be where you are, where will be your exit, your target on your trade, where you want to exit the market, right? Okay, so now this is how you drag the tool. Like, then this is for the sell. Now, if you're buying and you take your Fibonacci and you're dragging from a swing low to a swing high. So just think about it like this. If you are entering a buy trade, you drag from low to high, you drag from top to bottom. If you're looking for a buy trade, you drag from top to bottom. It's like you are going up, right? So think about it. If you're looking for a buy trade, you go up, you drag up from bottom to top. If you're looking for a sell trade, you drag down from swing high to swing low, from top to bottom, right? So just you could have that as an association in your mind to help you recognize where you should be dragging towards so that you don't make a mistake of it, right? I'll say that again. If you're buying, if you want to buy, if you're looking for buy trades, you usually would drag from low to high, low point to higher point, which is swing low to swing high. Then that gives you a retracement for a buy, right? Now, if you're looking for a sell trade, you drag from top to bottom, you drag it down, which is from swing high to swing low, and then that gives you a retracement for a sell. So now, let's come here, and then usually once you have dragged the chart like this, you realize that it's usually not highlighted. You see a red line in between, you find, I think red lines also initially when it comes by default, right? What you need to do then is click in the middle, somewhere in the middle. Then once you click somewhere in the middle, it becomes highlighted. You will see that there's a little dot, and 3 dots across the line. So you see a dot at the top, a dot at the bottom, and one in the middle. That tells you that it's highlighted. Now, once it's highlighted, what you want to do is you want to edit it. And the way you edit it is just right-click on it, and you go to Fib Properties. Go to Fib Properties. Now, you notice here now, I said that I already edited this one. So you notice here you have 0, you have level and description. Level and description. Now, for this level, you are going to be using 0 here and 0 here, 0 here and 0.0 here. So that will be there by default. Then you have other levels. You have the 23 level, you have the 31 level, then you have the 50 level, you have 61.8 level, then you have the 100 level, you have the 161 level, you have the 200 and something level. There are several levels there. So what you would do is this: you want to edit this Fibonacci, and then the only ones you're going to leave here are the 0 level, the 50 level, the 61.8 level, the 100 level, and then you can then add another level, and that level will be 78.6. And what you're going to do is that the 21 level, 22, 23 level, all you need to do is click on it and delete. Click, delete. Then the 31 level, you click on it, you delete. So you're going to delete the 23 level, the 31 level, then anything beyond the 100, all those levels beyond the 100, delete them as well. You delete everything. The 100 becomes the maximum that you will have here, right? Then to add the 78.6, all you need to do is use the add button. Click on add button like this. Then you will type 0.786 on the left-hand side because you're trying to add the 78.6, 0.786. Then on the right hand, you double-click again, and then you type 78.6, 78.6. So on the left-hand side, you put the decimal. On the right-hand side, there's no decimal. So on the right-hand side, you have 0.786. On the left-hand side, you have 0.786. On the right-hand side, you have 78.6. Now, you don't have to do this for any of the other levels that you have remaining, 0, 50, 60, 100. You don't need to do anything with those ones. You don't need to bother yourself with those ones because those ones are already fixed. You know, they are fixed by the system already, right? So this is the way you put it. See how I did it now, right? It's now fixed there. So since I have that already and I was just basically illustrating, I will delete it now. So I click on it, deleted. So you see, it's deleted. I now have just, I have 0, I have 50.0, I have 61.8, I have 100.0, I have 78.6. Those are the 4 levels, right? Is that 4? 5 levels. Those are the 5 levels I have on the Fibonacci, and I click OK. So once I click OK, now I have my Fibonacci. Now you can change the colors as well. Now you can see my colors here are black. And the reason my colors here are black is because I'm using a black screen. So if I'm using a black screen, sorry, I'm using a white screen. If the colors here, I think it comes in yellow, it comes in red, the middle one is red, and then the lines are yellow. Okay, so I use a white screen, so I change the color. So if you're using a black screen, you might want to use maybe white lines or yellow lines, which is the default. You can leave it there the way it is, or you can change it to whatever colors that suit you. Okay, the way you do that too is by making sure this line is highlighted. You go to Fib properties, then you see these lines here. This is black. Okay, you can change this color. I can change this color now to let's say blue, deep blue. I click OK. So the lines have turned to blue. Okay, it's not very clear, but you can see the words there, 50, 61, they are now blue. Okay, let's say we change it to something easier to recognize. Let's say we change it to what now? Orange, red, no, crimson. Let's say we change it to aquamarine, right? So we can see the colors now, very obvious. Now everything is changed. So I will prefer black. I'll change it back to black. I change it back to black. So I just want to show us how we could get that done. Black, okay. So they are all back to black now, right? Now, what you are looking for is these lines here. Once you are done editing your lines, you should have it appearing like this. So you have black lines, you have the 0 at the bottom, you have 100 at the top, you have 50, you have 61.8, you have 78.6. Now that you have this, now you are ready to use your Fibonacci. Now, what you are looking for is these three levels here, 50, 61, 78. Those are the levels you are going to be watching. Those are the critical levels. The 100 and the 0 are just like boundaries. They are just boundaries of the Fibonacci, right? When price moves to either the 100 or the 50, then of course that is a change in direction. That is no more a retracement. That is a change in direction. So if price moves from this bottom, you have swing high, swing low here, right? Swing high, swing low. If price moves from this bottom all the way to this top, that is no more a retracement. That is a reversal. That's a market reversal. Okay. And we are not really talking about reversals here because retracements, now reversals are good. They give you trading opportunities of their own. But this particular method here is not to trade reversals, is mainly to trade retracements. Okay, that's why it's called Fibonacci retracement. So let's attempt to use it now. Like I said, what you are looking for mainly are these three lines. The most significant ones are these two, 50 and 61.8. In certain occasions, the 78.6 comes in. That's why we just have it there. We have it on standby just in case we will need it, right? But most of the time, when you're dealing with retracement, you're dealing with the 50% level and the 61% level. This 50% level is actually indicative of the distance between 0 and 100. So when you have a move in the market, you have a swing high, a swing low. Let's say from this swing high and swing low right here now. This is top, this is bottom. When price pulls back, it is expected to pull back into the mid-level of that move here. So this move from top tier to bottom, price is expected to pull back into the middle of that move and then continue in the direction of the market. We can already see from here that the market is trending downwards. Okay, so how do I know? Because once price breaks out like this and starts coming down, I can't just jump into the market and trade again like that. That is not the right way to do it. Or I can see this candlestick, come down, and then I enter and start selling. Yes, it might still sell, like we're currently seeing in gold right now. Gold is buying. Now you can still buy, right? Or in this case, you can still sell, but it's not the best scenario for you to get the best value. At that time, because the move has already happened, there's going to be profit taking. And when traders who are already in profit from this move, from this top here, when they're already in profit, you realize that the opportunity around this area becomes smaller. the opportunity for you to make profit around this area becomes smaller. So this is why it's necessary to wait for a pullback. A pullback is known as a discount level. So it's like something is too expensive, you wait for it to get on sale. So you want to buy, but you're like, oh, the price of this thing is too high at this time. I want to, at a certain level or at a certain date, at a certain time, this thing is going to go on sale. Sale means that the price is going to be reduced. So I will buy it when I will buy the same thing at a reduced price. Now, imagine you are someone that buys and resells a particular commodity. And then where you buy from, there's usually a time where they are on sale. Okay, just say you're buying the thing for $10, and then you usually buy for, let's say you're buying for 20, you usually buy for $20, and then you sell for $40. You buy for 20, and then you sell for 40. That's what you normally do, right? Now, there's a time where that thing is usually on sale, and then there is probably a 25% slash in price. So the same thing you used to buy for $20, during this period of sale, you buy it for $15. So if you buy it for $15 and you are still going to go and sell it at $40, your profit will be more. So imagine now that they are going to start selling this thing for $15 next week, but you have already stacked up on it. You already bought a lot at $20 this week. You come there on that day, there's no more money to buy, right? Or somebody that went there and bought for $15, he will make more profit than you. It's not as if you will not make a profit or you will make a loss. No. But someone who bought at a lower price will make more profit than you when they sell or when they resell. So that's the way it is in the market as well. I will say that in the market, you are always buying and selling. You're always exchanging value, right? Now, if they are always exchanging value, you're buying and selling, this retracement is very important because it's a way of getting into a trade at a discount level. So when price makes a move, whenever that move goes, we call that premium level. So this is a premium level right now. Remember, if you are getting on a buy trade, you want price to come lower before you buy. If you are getting on a buy trade, you can see price is going to buy, price is buying. You want price to come lower, that's a discount before you buy it. If you're selling an instrument, you don't want to sell it so low. You want it to go higher before you sell so that you can capture the move as it comes down. You want to be able to capture the move as it comes down. Okay, this is where the idea of premium and discount came in. And that's where the Fibonacci becomes very useful to us, right? So let's start by doing something. So first of all, you want to see a clear move in a particular direction, right? A clear move in a particular direction. So if you look at this now, price made a huge move downwards. Broke this level here, came all the way down, to this level. Then once price made this move, we already expect that price is going to continue to sell. Why? Because it broke out of this level. This is what they call a change of character, which means a breakout of a level. It broke out of this level. Once it broke this level, you could expect, because normally what you expect for price to do is that price will hold. This is an area you will call a demand zone. This is an area you would have called a demand zone when price was going, when price was coming from this top, you would have expected that when it gets here, it will reverse and start going up. That's what's expected. But you see, price broke out of it. When price broke this level, then that is when we see that, oh, okay, price has broken this level. We should expect to see a downward move in price. We should expect to see price trending downwards, at least for some time, right? May not be like a significant change in market direction, but at least we should see price moving downwards because it did not break this level for nothing. It didn't break a support for nothing. So since it didn't break a support for nothing, that tells us that market is going to at least move downwards for some time. So what we start to do now is that, okay, now we can see this is a swing high, this is a swing low. Sorry. So now we can see that this is a swing high, this is a swing low. What we are looking for now is a discount level. Discount level is we are expecting a sell. If you are expecting price to sell, you can't be selling at a low point, a point that is so low, because your potential profit is going to be small. If I expect price to get, if I expect that, how do I do this? How do I say this now? If I expect price to, let's say, how do I do this? Let's say I'm looking at this right now, right? Let me zoom a bit. I'm looking at this, this bottom now. Let's say I'm expecting price to come from where it is now. Look at the current market price, 0.64935. That's the current market price. Let's say I'm expecting the market to sell down to this point. Sell down to this point here, this point where my cursor is now. See, from this to this point. That is literally how many pips now? That's literally how many pips? That is literally 7 pips. Now, this trade is a low reward trade. The reward, the potential profit on this trade is low. But imagine that I waited and I took the trade at this top here. I am expecting to come down, but instead of entering this trade here and catching only 7 pips, I enter at the top here. And I catch it all the way down. See? I'm doing 25 pips now, 24.8. 25 pips now. So which means I made more profit if I entered at a higher point on a sell trade. On a sell trade, I made more money because I entered at a higher point in the market. So that's what we're trying to do, basically. That is why we are doing retracement and all of that. That's why we're doing retracement. So what we'll do here is we'll take this swing high, we'll take this swing low, and we plug our Fibonacci into it. Remember, I said that when you are expecting price to sell, you're expecting price to come down, what you do is you pick your Fibonacci and you drag from top to bottom. You pick your Fibonacci, you drag from top to bottom. So that way, you are able to capture the retracement, and then you're able to get on that sell trade. That is for a sell. So what we do is we use this top and bottom, top and bottom. So click here, put it on top here, and then we'll drag this bottom here. Okay, we'll drag this bottom. We'll drag to this bottom. As we drag to this bottom, now we are expecting that price will hit this level. This level is what we are targeting. This level is what we are targeting here. We said the most important level here is the mid level between the 50 and the 61.8. That's the way we do it. So we want price to move into this level. This is where we want to enter for a sell on this trade. This is what the Fibonacci is telling us. Get on a sell around here. But you can see it looks as if price didn't quite reach that point before it drops. This happens periodically. That happens periodically. When you are expecting price to get to a certain level for you to buy or sell, and it just misses your entry, it doesn't quite get to the point where you are expecting to buy or sell. That is very natural. Those are some of the things, those are some of the challenges that traders face in the market. Those are some of the challenges that traders face, right? You have a situation where you missed a trade. You have a situation where you close your trade too early. You have a situation where you close your trade too late. You know, all those things are things that you get to. Some of them are not. Some of them are. It gets better as you become a better trader, but there are some of them that don't necessarily change. Just stay the way they are, right? An example is missing a trade. Can't get so experienced in the market, so sophisticated, a trader, smart trader, that you don't miss trades anymore. No, you may not You may now be very good with using risk management and a lot of things, but there are times you will miss trades. You know it, you understand this market. You can see that this price just did not get to my entry. Missed my entry by 2 or 3 points. While I was trying to get a very good entry, market just left me and started doing his own thing. Those things are true. That is an example here of how we didn't know that market is not going to get to the 50% level before selling. It can close, but it didn't get it. All right. So now, when you look at this, once that happens, you ignore this move, ignore it. What has happened has happened. So there's no need to beat yourself up over that. The next thing is, what you are thinking is, what's the next move? What's the market doing next? I already expect it sell. And now you were expecting to get on this sell here, and it just didn't happen. So since it didn't happen, you watch. Remember, you're not going to jump into a trade just because price didn't get to your level. You won't jump into a trade, right? So price started coming down, and suddenly it broke out of this place and just dropped very heavily. Dropped. So now that it has broken this level again, changed, it broke this previous level we checked before. So you see, it broke this level we're looking at before, broke that level. So this was here before then. You see how it broke that level? As it broke that level, we are saying, okay, we expect price to start to sell now. And then we put our entry here. It didn't get to our entry, it started coming down. And then it broke again. Once it broke again through this level, now you can see how this is the level it now broke out of. Can you see? Broke out of this level again. Now, once it broke this level, that tells you an opportunity for me to enter is coming. An opportunity for me to enter the market is coming. So you position yourself and start waiting. What you're looking for now is this one here, this level here becomes your new swing high. Remember we said you are dealing with the most recent swing highs. Most recent, right? The most recent swing highs, that's what you're looking for. Now, this becomes, remember, you're expecting to go up here. If you had gone up here and reversed from there, that would have still been your most recent swing high. But since price didn't get there and then started coming down, okay, fine. You can then use this level now. You can still use this level for something valuable. Now, this becomes your most recent swing high. Remember, we are dealing with most recent swing highs. And what is a swing high and a swing low? An area like this where market change direction. That is what we call a swing high. Swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing low. That's just how it's done. Okay. Now, this becomes your most recent swing high. And as price dropped to this level now, this level becomes your newest swing low. Your newest swing low. This becomes your newest swing low. So this is where you want to use your Fibonacci now. The question is this: I have seen my swing high. I have seen price changing, making a reversal and trying to go up. I've seen my swing low now. I've seen my recent swing high. I've seen my swing low. So this is the time for me to take my Fibonacci, drag from top to bottom, so that I can get my area to enter the next sell trade. This is clear to me that it's sell. Why? It keeps breaking supports. It keeps breaking levels and going down further. So those breaks that are happening tells us that market is trending down. It's clear the market is trending down. It's forming lower lows and lower highs. So once you put your trend line there, even your trend line, you can easily see that market is trending down. Okay, with your bare eyes, you can see that the market is trending down. So with the market trending down, you're looking for good quality trades. Remember this, in a downtrend, the best type of trade you should be taking is a sell trade. It's not the only available trade. It's not the only type of trade you can take. You can still take in a downtrend, you can still take buy trade, but they will be short-lived moves. They will be short-term moves, short-term moves, short-term moves. Just like you buying from here to here. Short-term, you don't even know how you need to be careful when trying to trade against the trend, because this is what we call trading against the trend. You're moving against a moving trend. You have to be careful how you do. You have to be probably on cruise or something to be able to survive. So the best opportunities for you to make money in the market is to trade along with the trend, trade in the direction of the trend. So what we'll do is that we have seen the swing high, we've seen the swing low. So we take Fibonacci, we'll drag from top to drag from. And you see now that the price actually dropped in between the 50 and the 61.8. Can you see that now? Price moved into this area here, and then what happened? It danced around there for a while and suddenly it dropped. Let's check how much profit could you have made here if you traded it? That's 77 pips. Even if you said, okay, I'm not going downwards there, let me close out here. You still close out at 50 pips. 50 pips. That 505 there is 50.5 pips. It's 505 points. Okay. See 505 in the middle. It's 505 points, which is 50.5 pips. Even if you captured 50.5 pips here, that'll be good. If you place it one standard lot trade there, that's $500. Simple as that. Simple as that. So that's the way it's done. And see how this level held the market, and then suddenly it dropped from there. So this is not accidental. This happens most of the time. Very, very often in the market happens. So, and something you notice is that after price had dropped, it now started coming up. Looks as if it broke the trend line. You see this trend line that was separating, that was showing you that you're in a downtrend. Every time price got there, it reversed. Every time price got there, it reversed. It was more like a partition between a sell and a change in direction. Once price broke through it, that signals a change in direction. That signals a change in direction. Sometimes it might be an overall change in direction. Sometimes it might be a short-term change in direction. Maybe price will now move from here all the way to the top here and stop, but it could be a short-term market reversal. For me, because I'm on a 1 hour chart, this might actually be a short term. By the time I see this on a 4 hour on a daily chart, I know that, oh, the market has changed direction. Though a 1 hour chart is not bad, it's very good as well that you could use. I'm just saying that in some cases you might use a longer time frame than just 1 hour, right? So now let's look at this. We see that the trend line has been broken. Since the trend line has been broken and we are seeing signs that the market is changing direction, what we need to do next is this. We need to pick, now market has come here, it's stored around this area, right? Then it made a move up, So this becomes our swing low, this becomes our swing high. Swing low, swing high, okay? So let's try this. In this case, what we are doing is that we are still not sure if this is a sell. We're still not sure if this is, at this point, we are not sure that the market has changed direction to a buy yet. Very likely what we are still going to do is we're not even doing this yet. We are using this as our swing high and this as our swing low. This here swing high, this here swing low. Okay, This level swing high, this level swing low. So we will yet use a Fibonacci again. So in this case, we've already caught this move. 50 pips, 70 pips were out. Good. Now, the next thing is, let's go check this out. Okay. Take off this. That's gone. We remove that one. This market has played out already. Good. Now, what we want to do is we want to use this most recent swing high and swing low to catch the next place where we might get in the trade. Okay. So we pick our Fibonacci, come here, we drag. Once we drag, you notice something here. Look at price came into the middle of that move. That's got to the 61.8 now. Instead of getting to the 50, sometimes it gets to the 50, sometimes it gets to the 61.8. From the first one we saw, we see that it was in between 50 and 61.8. Now it's also in between. It breached the 61.8 a little, but it did not breached it with wicks, with shadows, not with the real body. A real body breakout will tell you that, oh, this thing is going to change direction. A real body breakout of a trend of a Fibonacci tells you that market is changing direction, right? So in this case, now what you do is you can see you can enter this for a sell, but you notice that you enter this trade for a sell, the thing did not sell. What happened? It moved up, moved up, moved up, moved up, moved up. Then what happened here? It broke the trend line. See, it broke the trend line, started going up. That tells you that direction in the market has probably shifted. Sentiment is shifting bullish. Sentiment is shifting bullish in the market. You have to observe what's the market doing, right? Sentiment is shifting bullish in the market. So because of that, this is where you will close your trade in maybe a small loss. And always remember, guys, this is why we preach risk management. There is no way to avoid making a losing trade in the market. There is no way to avoid making a losing trade. If you want to completely avoid making a losing trade, you should basically not do business or investing or anything that has to do with economic activity. Because if you're involved in anything that has to do with economic activity, there is a potential for a loss sometimes. So it's not that you are overall losing, but you may make a loss which you will recover in another way, which you will recover with profits in the future, right? Which you will recover with profits in the future. So this is what happened here basically. You made a sell trade and then market broke up. Broke up, that was a little losing trade there, right? Market started going up. Now this is where you want to position yourself because you can see trend has changed. You can see that trend has changed. You can see now that you need to be positioning yourself on a buy trade rather than on a sell trade. This is where you want to now use the Fibonacci again. This time, you are no more anticipating a sell trade. You are now anticipating a buy trade. So that what we'll do is that we'll take our Fibonacci, we'll put it here at the bottom, we'll drag it to the top, and then what we're looking for is this area here, this 50%, 61.8% level. And you see price got into the 50% level, and then what did it do? It moved up. It's going there again, it got there again, and moved up. So for me now, I can expect to enter a buy trade around this level, 50% level, and then I'll expect for the trade to probably terminate around, at least I'll take profit one, would be somewhere around this top here. Okay. So this should be somewhere like a trade like maybe a 30 to 40 pip trade, right? 30 to 40 pip trade from this bottom to this top. This is AUD/USD. So this is Fibonacci telling you how to get on a trade. And by the way, you would have already gotten on this trade here. and then you made a move. He made a move. This trade already played out from here to here for over 30 pips. And this is, you can see how Fibonacci could have helped you get on that trade for a buy, right? So this session, guys, this thing has to do with a whole lot of practice, right? So that's why I'm taking my time to explain it a whole lot, so that we can take this class, this recording, and then go practice this again. It's important you go and practice this, because when you like I was telling some people today, the more you see, the more you see it. The more you see, the more you see it. So the more you see, the more you see. It's very, very important. So we're going to end the class here. We are out of time already. We're going to end the class here. Now, you are going to, like I said, you are going to have to practice this a lot. When you practice this a lot, you'll be able to begin to use it very, very easily. All right? Okay. So do we have anybody who has one question? One question. We have just barely 3 minutes at the end of this class. Barely 3 minutes at the end of this class. So
I have a question.
Yes, please.
Okay, actually two. Sorry. So now I was asking, so for the Fibonacci tool,
Yes.
it has to touch the highest points of the swing high and the lowest point of the swing low, right?
Yes, correct.
Okay. Now the
Yes.
second question is, so when I'm drawing the Fibonacci, what time frame should I use? Because I want to believe that I'm going to enter the trade with a low time frame, right? And identify the trend with a high time frame. So which time frame do I draw the Fibonacci to determine my entry?
Okay. For the Fibonacci actually works on all time frames. Okay. Whatever time frame we want to use. But here's how I advise you use this. You see how I started. I said, first of all, you determine your trend. So you determine your trend on a higher time frame, like maybe 4 hour or even 1 hour. If you zoom in on your 1 hour chart, zoom in now, zoom out. Zoom in on your 1 hour chart, you can see trend on your 1 hour chart alone, right? Or you can do it on a 4 hour, just for you to see your trend. Once you've seen your trend, you can go to a 15-minute time frame or a 1 hour time. I prefer to do this on 1 hour. I do this a lot on 1 hour. So you can do it on a 15-minute time frame, but you want to look for trades in the direction of the trend that the higher time frame already confirmed for you. All right. So you are not using you are going to, if you go to a higher time frame and you see that the market is bearish, when you go to 15-minute time frame and you want to trade, look for bearish, use the Fibonacci in a bearish fashion. Don't use it for bullish trades. Use it to look for bearish moves in the market. Then you'll be in good shape. Does that make sense?
Yes, it does. Yes,
Okay.
it does. So I'll keep looking, I keep moving with it, with the swing high and the swing lows,
Yes.
based on the trend that I've been able to identify.
Exactly.
Okay. Okay.
Yes.
And so also the other thing is that I've noticed that you put the trend line. So it means I have to always put the trend line first and then be able to.
Why I use the trend line is because in this case, it helps me to just see what I
Because you're
could
using
see on this chart.
candlesticks. Okay.
Yes, I'm using candlesticks, but one thing I could
Okay.
see here is that the trend I could see a trend, but I could see the potential for a change in trend as well. So a trend line here helped me to separate. It helped me, using a trend line here could show me easily where the market seems to be changing direction. So it doesn't mean you have to use it. If I zoom in here, what do I do now? I zoom in like this and zoom in. Well, I don't necessarily need to use a trend line. This can tell me the market is still a bit bearish. But when do you know when the market changes direction? This trend line helped me to see that it seems like the market is shifting bullish from bearishness.
Okay.
So you can tinker with it. Try and use the trend line. Sometimes you will use it, you will need it. Sometimes you will not need it.
Okay. Okay. Thank you. Thank you.
Thank you. Now we are fully out of time. So thank you guys for coming. I'll see you guys on the next one. You have a wonderful day. And also this recording, we will make it available on our YouTube very shortly. All right. Thank you.